Coming up next on the Jeff Crilley Show, if you watch the financial networks, they talk about stocks all day long, but we'll be talking to a couple of financial strategists who say you should be looking at bonds. That's just ahead.
Many are predicting that the worst is yet to come, which is unfortunate, said one person here. Until now, they've enjoyed the reputation of being the nation's icebox.
Watched a burglar in his home this morning by webcam.
As a journalist of over 25 years, stories are what make my world turn.
Reporting live from the Dallas newsroom tonight, Jeff Crilley, Fox 4 News.
But in 2008, I took the jump from my familiar life and started a PR firm from my home.
We're talking about anyone with a camcorder like the one I'm using becomes a television network.
We started slowly growing the company, and we now have over 100 clients, and we've branched into the world of live digital broadcasting. I now own 8 different TV studios and have a huge team, and the stories that I now get to share are sometimes the most important of my life. Life has a funny way of coming around full circle. This is the Jeff Crilley Show.
Well, all of us know stocks and bonds, right? Well, in the last few years, stocks have gotten all the limelight, but a couple of experts are with me in studio today to talk about why bonds should not be overlooked. David Roosevelt and Mike O'Brien, they are with Roosevelt Capital Management. Thanks for coming on the show.
Jeff, thanks so much for having us. It's great to be here.
David, we're going to start with you. Now, Roosevelt is a very famous name, and it's not an accident. I mean, you're a direct descendant of FDR.
I just happened to be born in the family. Didn't do anything special or unique.
He was your great-grandfather?
Franklin was my great-grandfather. People will say, well, how about Theodore as well? And Theodore, interestingly enough, was my great-great-uncle. And little-known fact, I think this was on Trivial Pursuit, but do you know what Eleanor Roosevelt's last name was before she got married to Franklin? It was Roosevelt.
No kidding.
Franklin and Eleanor Roosevelt were 5th cousins. Theodore gave Eleanor away at her wedding to Franklin.
That is crazy. Do you get comments like that all the time when people say Roosevelt like the president?
Occasionally. My wife, when people ask, I found that there are members of the family who would actually say, no, I'm not related. And my wife said, David, you actually need to say you are related, not because you did anything special, but it's because it can be special for them. And so I do make a point of saying yes, but very importantly, Jeff, I have 2 of the greatest parents in the world. I'm so thankful for my mom and dad. And my dad especially raised us to believe that this is a real responsibility. It's a very unique and special heritage to be from, but it is not an entitlement in any way, shape, or form.
Mike, let's bring you in on the conversation.
Yep.
Any presidents in the
family
tree?
No, a car dealer. An engineer.
We were talking before we went on the air that you and David met, and you have a special bond. It's a different kind of wealth management company, isn't it?
Yeah.
How did you meet?
Well, so we probably have known each other for maybe 10 years, but we got started on this business over a cup of coffee at a special needs basketball game. I think we were at McDonald's, right? Yeah, we were at McDonald's 5 or 6 years ago, and I don't have a finance background. I'm a data guy, and we just got talking about a model that David was using in Excel, and he said, what if you just maybe you want to play with it a little bit, I'd love to see what you could do with it. And so from that cup of coffee grew this business. Although David had the idea for the business years before we met, that was how I got involved.
Yeah. And when we talk about this being a very special wealth management company, it's not the company that is trying to churn your account to make money for themselves. It's a very different company, isn't it?
Yeah, we get paid if our clients do well. We get paid a percentage of their assets under management. So if the clients do well, we do well. If the clients do poorly, we do poorly. Very importantly, we're not the type of fee structure that we get paid more if we buy more or sell more on behalf of the client.
Okay, let's talk about bonds. Why bonds? Mike, some people, if you went to a cocktail party and you started talking about bonds, you could clear the room. But you guys think bonds are sexy. Tell us why.
We do. Although I think we could probably clear the room as well. I think you actually have quite a bit more control in the bond world. You have the ability, unless there is a default, you know the answer. So as a data guy, it's a really interesting thing to work on. And I actually think it's far more straightforward to add value or to try to add value than in the equity markets. And that was, I would say that's really David's teaching of me over the last 5 years. But again, as somebody who's sort of worked in and around information for 30 years, to know the answer or to know what the answer is going to be within the range of a couple of outcomes makes the analysis really interesting.
Well, yeah, we're good.
Well, let me just expand on that. To Mike's point, when you buy a stock, you are forecasting, hoping that it goes up. When you buy a bond, you know exactly the worst case return you possibly can get, barring a default, that is. And so that's what we really focus on. Is this company going to pay this bond when it comes due? And I'm sorry, I cut you off.
No, we're going to put up your strategy page so people can get an overview of what it's like to work with you. So when somebody comes in, you explain why bonds can really have a great return.
Yeah, so when we read the Wall Street Journal or we look at various web pages, we'll see that people are talking about how poor bonds are today. And in many respects, that's 100% true. Mike and I agree with that, and that yields here in the United States are about as low as they've ever been. When we say yields, we're talking about U.S. Treasuries. Continuing with that, you go to Germany, Switzerland, a huge part of the world's fixed income markets are actually trading with negative yields. You actually pay somebody to take your money. Isn't that pretty crazy? Yeah. So we specialize in a very, very narrow area of the bond market. High yield corporate bonds. So these are bonds issued by U.S. corporations or foreign corporations that are issuing U.S. debt. The high yield market means the non-investment grade market. So these bonds are more risky than what we call investment grade bonds. It's that risk that we really specialize in. And then another component of what we're doing is we're focusing on what we call short duration. What is short duration? That just means bonds that come due in the near term. For us, we consider that about 7 or 8 years. And that means that these bonds don't have a lot of sensitivity relative to longer duration bonds to interest rate movements. What's interesting, and not a lot of people understand, is that if you allocate capital to a 30-year treasury, you might not be taking a lot of default risk because the U.S. Treasury is considered the best credit in the world, but you are taking huge amounts of interest rate risk. If interest rates go up a little bit, that 30-year bond will depreciate significantly, and that's just the math. So in an environment like this, where yields are really low, we don't want to take a lot of interest rate risk on behalf of our clients. And then we do take default risk, but that's what we are specialists in taking.
So, Mike, when I've been watching CNBC and Fox Business Channel in September, it's been kind of dismal for stocks, but that gets you guys excited, doesn't it?
It does, yeah. I mean, we look for volatility, and we want volatility, and that because that's good for our clients. When we have the ability to move in and out of bonds, not because we're speculating on the bonds we want to buy, but again, because we, short of a default, know the answer, we can continuously sort of look and prune and refine the portfolios that we own for our clients.
And we're going to put some of your recent results on the screen. These are unbelievable numbers for bonds, aren't they?
Those numbers, the near-term numbers that you just saw, they're actually a function of COVID. COVID was a horrible event. I hope we never have to go through anything like it again. But the fact of the matter is markets do go through volatile times. We're actually seeing a little bit of volatility today with the equity markets off 1.4%. We are always looking for those opportunities to deploy capital in bonds that others are fearful of, But given our process and framework in terms of analyzing these things, we'll say, the probability of default is actually much lower than the market is pricing in. And so it makes a lot of sense to deploy that capital. So during COVID, we were buying bonds 65 cents on the dollar a lot of times. Those were bonds that somebody was saying, I'm terrified of owning this. But we had looked at the amount of cash that was on the company's balance sheet, their available revolving line of credit, and seeing whether it was covenant constrained or not, seeing what their expected free cash flow was going to be, looking when other obligations were going to come due in the capital structure, and saying, is that bond that's being traded at, in this case, 65 cents on the dollar, is it going to default? And the vast majority of the time we said the probability of default is very, very low, but the market is pricing in a very significant probability of default. So we love opportunities like that. Those opportunities don't exist in an environment like we are in today because there's very little fear in the market. One of our favorite lines is Warren Buffett said this. He said, be fearful when others are greedy and be greedy when others are fearful. And we really deploy that. In an environment like this, we can deploy capital in a 25 bond portfolio at around a 4.5% yield to worst is the lingo. And then we hope through active management, and I shouldn't use the word hope because hope doesn't have any place in an investment strategy, but through active management, if volatility comes, we believe we can add another 1 to 2% over and above that. So we have a very defined process. We're looking at every single bond in the market that we possibly could buy every single day. We're monitoring those, not only from a price perspective, a yield perspective, but also from an underlying fundamental perspective. So when others are fearful, if there is an opportunity to be proactive and buy those bonds, we do.
Wow, makes a lot of sense. Mike, what's one of your favorite client stories?
Oh man, well, so I would say we have a wide variety of clients, right? But I personally really enjoy working with more of the retirees. I think because oftentimes we can have a really material difference in their income without a dramatic change in kind of the overall perspective they had on the way to approach their IRA, for lack of a better way of saying it. So, for example, we've got an individual right now who, to David's point, was heavily in treasuries, felt that he was very safe in those treasuries, and just completely by circumstance happened to move those out of treasuries and into our portfolio sometime when maybe March or April last year, right around when COVID happened. And he would have been down 20-30%, I think, at one point because of the, there was no risk of loss of principal, but there was a huge potential risk from the price declining. And so we've got that individual in a portfolio now. He's earning 4 or 5%, doing really well. And I'd say we've got a dozen or so of those examples where we're really helping people who would otherwise just be sitting in cash because they're at a point in their life where they don't really want to be in the equity markets.
David, I'm going to ask you the same question. Tell us a great client story.
Well, I love working with retirees as well. But one of the neat things about what we're doing is it doesn't just help or benefit the retiree. Anybody who needs income, it can help. So we actually had a multi-billion-dollar corporation come to us recently. The business that this corporation in is very regulated. So they cannot deploy capital in a lot of different areas, but they can deploy capital in short duration, high yield corporate bonds. So we put them in a 25 bond portfolio, and they're getting a return that they would otherwise never be able to get in the types of strategies that they were deployed in when they came to us.
No kidding. This is all fascinating. We've got about a minute left, so I'll give you both kind of a final thought. What would you like to leave the audience with?
Yeah, it's just a privilege, Jeff, to be on your show. We just so thankful that we were connected, and grateful to have the opportunity to talk about bonds because everybody's so negative about bonds. But the fact of the matter is there are pockets that are really, really, really interesting. Oftentimes you do need a professional who has been focused in this area and can help one navigate the risks. But there are really interesting places that do help people get good returns in what is a really challenging environment otherwise.
Would you say it's accurate to say the only thing we have to fear is fear itself? I'm sorry, I had to. It was too easy. Mike, we'll give you the
We
final
can fear
word.
defaults as well. Fear and defaults.
Yeah.
Mike, what would you like to leave the
I
audience
don't know
with?
that I have much else to add. I think David summarized it pretty well.
Outstanding. Well, we're going to end with your website, which is rooseveltcapitalmanagement.com. David and Mike, thanks for coming on the
Hey,
show.
thanks so much,
you.
Jeff.
You bet.
Yeah,
And
bye-bye.
that's it for now. We'll see you next time.